Okay, so today we are going to learn capital budgeting, also an investment analysis technique. Whenever you hear of capital budgeting, we are talking of making decisions, spending a long-term investment. So, like fixed asset, like new product, right? So in a long-term project, and we do a lot of take the right decision. It involves a lot of cash. It involves a lot of money. It involves a lot. You need to make the right decision. So there's a need to do capital budgeting or investment analysis. Okay. Now, when you talk of capital budgeting, we are talking of evaluating a long-term project, deciding whether to invest or not, based on the cost and benefit. Like I said, we are looking at long-term projects, not an product. Investing in fixed assets, right? Like land and building, plant and machinery, wasted development. All these things involve huge sums of what? Cash, and therefore we need to make a very good capital investment decision so that we don't end up wasting our capital. We don't end up causing harm to the uh, company. Okay, all right. So that is it. Now we have to understand some important concepts of the capital budgeting. Opportunity cost. Whenever we talk of opportunity, we are talking of the next best alternative investment. Okay? The next best alternative investment. So we are making a decision whether to invest in a project or not. Now we are also looking at the possibility there will be a better option there. Right? So if there is a better option, for that one. Then we have time value of money. Time value of money. When we are talking about determine what the NPV of what of cash flow. How do you determine NPV? How do you get NPV? NPV is between the standard cash flow and cash inflows minus cash was outflow. So that is it. Okay, so we discount the cash inflows. The cash will be expecting to come in from yes, and then we subtract the cash outflows. And then we normally use the cost as in the initial capital we spend in getting the project started. We spend the capital that goes into before the project starts. Along that, I think I spent and then that will be additional cash outflow. Okay. So that is it. Now we have the method for evaluating or the technique for evaluating capital budgeting or evaluating this long-term project. We can be broadly classified into traditional method. Traditional methods are normally non-discounted method and the modern method. Okay, so we are first going to deal with the traditional method, which starts with what? Payback period. We start with what? Payback period. Now, what is payback period? Payback period, we are looking at the number of years or the period it takes us to recover our initial capital. The capital we invested into the project to get the project to start. That's what we are looking at. So, how long will it take us to recover our capital? The shorter the period that will take us to recover our capital, and we say yes, then that is the best investment. That is the project we choose. This project is going to we are going to cover our the capital we invested earlier. Then that's the best project we should go in for. Now we have the advantage and disadvantage. Let's look at the formula. So this is the formula. Year before full recovery, right? So there's some amount for full recovery. Then the remaining cost at start of the year and the cash flow during the year. So when you get to solving a question, but then you should understand that this type of capital budgeting or investment evaluation method is easy to calculate, easy to understand, right? It reduces the possibility of loss due to obsolescence, right? That's ignore time value of money, which is very relevant in what finance. It doesn't take into consideration the cash flow that will be received after we have recovered our capital. Now, we are looking at the returns. If I invest, I want to. We are not looking at just looking at the money that invested, but they want to recover that money, right? And when you invest in money, you want to get profit on it. You want to get some return, right? Every investment, there's expectation of what? Then, okay, so that is it. Then it can be a misleading technique. Yeah. Okay, so this is an example. Now the formula, let me bold in this. Okay, bolding. No, let me increase it to 14. So yeah, so it's year of full recovery and what remaining cost at the start of the year of as you have got last recovery and cash flow during the year of that the last recovery, the last amount to recover. So let's look at this question, right? Let's look at this question. Let me highlight this one too. Let me increase the font size. So I think you can see it well. Okay. So this is a project that is under evaluation, whether we should invest or not. And when you see year zero talking about the amount invested, right? So year one, the cash flows, since the cash flows coming in after the investment what took place. So there's the cash flows what coming in. We have 500, 400 for the second year, 300 for the third year, and 100 for the fourth year. Now, the purpose of payback period is to know how many years it will take us to recover the amount we invested. So we are want to determine the years it will take us to recover this 1,000 Ghana cedis. Okay. The year it will take us to recover this 1,000 Ghana cedis. Okay. Now 500. The first year we recover 500 of it. So that is 1 year, and we've still not recovered 1,000. The second year we are getting 400. 400 plus 500. We have what? 900. Okay. We have what? Let me bring back. So the first year. And we are doing cumulative. The first year we have what? We recover what? 500. And we need to recover 1,000. Okay. So the first year we recover 500, and we need to recover 1,000. So apparently we go to the second year. The second year we recover what? 500 plus 400. We have what? 900. So we have 900, meaning that what? We are left with what? 1,000, right? We are left with 100 because we invested what? 1,000 Ghana cedis, okay? 1,000 Ghana cedis, okay? All right, so minus 900, we have what? Minus 900, we have 100 Ghana cedis. Are we okay? Okay, there's a 900 Ghana cedis. But the third year, we have more than 100 Ghana cedis, meaning that on the third year, we recover more than the 1,000 Ghana cedi we invested, but we are interested in the number of years it takes us to recover the amount we invested. They're looking at the essence. Okay, so how do we get that? That's what they said was payback period. Payback period is equal to year of full recovery. And it's here, it's written in full year. Year of full recovery. Plus, okay, remaining what? I know why that both costs. It should have been the remaining cost at the start of the last year, right? The remaining amount, that is the 100 debt, right? Remaining amount at the start of the last year of what we call it. Okay, that is it, right? So we divide it by the total cash flow for the last year of recovery. But this I tell you, I'm basically going to recover our total amount here. I'm going to recover more. So we don't want more, we just want what we invested. Okay, that's the purpose of that period. Okay, so then the cash flow for the year of what? The recovery. Okay. For the year of the last year. So let's go. We have 2 years already. That we recovered what? That is 2 years. That recovered 900, and it's left with what? 100 cedis. So I want to see, okay, if the next year is more than 100, let's find a fraction of how many months or days out of that year that we can recover. So that is it. Okay. That is, so now we go to what did they okay. All right. So this divided by this is 3. So it means at the end of the day we had, let me put it here, right? Let me put it here. Okay. We had 2.33 years. So that is payback period. And so it means the remaining amount, 200 remaining here, and this 100 is now concern. Our concern is the number of periods it takes us to cover the amount. Are you okay? All right. So if the number of period is less than the predetermined one, then we choose that one. So if you have 2 projects and the number of recovery, we look at the lesser one, the one with the lesser number of recovery, that project. Okay. All right. So going to move to accounting rate of return or average rate of return. Okay. Now this type of evaluating a long-term investment, it involves looking at the entire profit or return we are going to get on the project. Then we are going to decide based on it. It's over on the traditional method, and therefore it is easy to calculate, easy to understand. It's based on accounting information, but it also ignores time value of money, which I say is very important in finance. Time value of money is very important. Okay. All right. So this is the formula. Accounting rate of return or average rate of return. The formula is average profit. Okay. Average profit over average investment. That's the formula. Okay. Average profit over average investment. Let me write it big here so maybe you can see. Accounting rate of return or average rate of return is equal to average profit. I'm just shortening. Okay. Average profit all over average investment. Okay. So that's the formula. Now we have to get average profit. How do we get average profit? Right? Average profit, average profit, then average profit. Okay, so we are looking how to get it. Average profit is equal to profit over number of years. So the number of periods of the investment is the average period, sorry, that's of, right? I'm not right. Number of what? Yes. So if we take 5 years for you to end the project, then you look at it and find average. So that's average profit. Now we have to go further. How do we get this profit? How do we get this profit? Okay. How do we get this profit? This profit is gotten by all cash flows. We will add all the cash flows from the project, okay? All the cash flows from the project. I don't know why I wrote it for, but the rest I'll just make it short. Minus depreciation. Depreciation is an expense, and it helps us reduce the tax we will do that, right? Over what? Tax. Sorry, minus tax. So that's how we get what? So we will get out all the cash flows from the investment, then we will subtract our depreciation. Okay, what we get, calculate our tax on it, and we subtract it from it, and we get the profit. Then the number of years is mostly given in the question. How do we get this? Average investment. How do we get it? Okay, so that will be I don't know whether this, okay, you can see this very well, but you let me write it. Average, so we've gotten, looking at average what investment. Average investment is equal to initial what investment. So initial investment, okay. Now the add report minus scrap value. That will be the amount you generated when the investment comes to an end. Everybody, you are selling the project. The amount you get out of it, what we call scrap value. So that is scrap value. Scrap value. Okay. Over 2. Okay, so that's it. Last additional capital. So if you spend, you make additional expenses on it, then you bring additional what? Working capital. Are you okay? So now we know how to get our what? Average profit. Okay. We know how to get our average investment. All right. So let's go to solving a question. So this illustration 2. And under illustration 2, you can see that we say initial investment is what? 160,000. It's Ghana cedi. We are in Ghana, so it's Ghana cedi, right? I didn't make any currency here, but okay. No scrap value with the cash, no scrap value. Now with cash flow, so these are the cash flows. So this is the lifespan of that investment is 5 years. The first year generated 56,000. The second year generated 48,000. The third year generated, let me make this 10 big, right? Okay. All right. Let's so that we understand the question. Okay. So initial investment is 160. We have no scrap value. These are the cash. The first year generated 56,000. Second year generated 48,000. Third year generated 8,000. 30,000. The fourth year generated 64,000. And 5th year generated 8,000. We're given what? It is depreciation is based on what? Straight line what basis. And tax rate is what? 40%. Okay. Now we said that profit over average investment. And we say, how do you get average profit? Average profit is profit over what? Number of what? Yes, okay. However, to get the profit, it is what? All the cash flow. So, by the depreciation, so first of all, let's add all the cash flows and the summation of all the cash flow. So that is it. That is it. So we sum all the cash flows. So we add all of them. You got 278,000. Okay. You add all of them, got 278,000. Now we have to subtract depreciation from it. We're not giving depreciation direct, but we're giving information that can help us to get it. I don't know the number of years. How do we get it? How do we get it? Cost minus time value with the number of years. All right, so we know that the cost of investment is what? Let me increase this. The cost of investment is what 160,000. Okay, so this is the formula. Okay. Okay, so this is, so we have to insert 160,000 here. The scrap value it has scrap, so that will be 0. The number of years is 5, so that's it. Minus divided by 5, you get what? 30,000. Are we okay? 32,000. Okay, so that is what? Straight line method. But this depreciation is for a year. It's for a year. So at the end of the day, you see we divided by 5. So it's for a year. Okay. So we have to multiply it by 5. Okay. But the cash flows we have here is the whole what? 5 years. Okay. There is some. So we multiply the okay. We multiply the 32,000 and the depreciation per year by 5 to get the depreciation for the whole what? 5 years. Then we come and deducted from the what? Total cash flow. Okay, total cash flow. Okay, so total cash flow that we got the one was 27,800, and we subtract the depreciation for. So the first step of getting profit, subtracting the depreciation. It's like we what? Subtracting the tax from it. Now tax is charged on what? The cash flow minus what? The depreciation. So we come to charge the tax on this 118. 118. So that's 40% tax rate of 40 times this. We got 47,200. We have to subtract it from it because according to the formula, profit is total cash flow minus tax. So we come and subtract tax from it. We come to subtract tax from it. So profit of one is 1 minus 8, and we got 70,800. Now we have profit, but profit over number of so that's it. Profit over number of years. So the profit is got is 70 over number of years is 5 years. Then we get what? 14,000. When you divide, you are getting what? 14,160. That is our average profit. Now we have to get what? Our average investment. Our average investment. And like I said earlier, the formula is what additional investment and spread over what? The number of years. And it has additional expense. That's what? Working capital. So that is it. I think this should come down to make a better understanding. Oh, come on. I didn't know line. Undo. What am I said? Oh, on the line, right? Yeah. Okay. Okay, so that will be it. So we didn't bring this because we don't have additional working capital. And then we don't have that information. So I shouldn't have even brought this at all. I don't know why it's here. But I just brought the formula. Let me just put for some students, when you put you don't bring it, they will find a way to bring things there. So let me just put 0 there, right? So plus 0, okay, because there was no additional working capital. Okay, okay. We are moving forward. So now we have everything, right? We have what average profit, we have what average investment. Okay, then let's calculate average rate of return or accounting rate of return, however you want to call it. So it's what average profit over average investment times 100. So the average profit was 14,160 over the average investment was 8,000. That's what you get times 100, get 7.7%. Okay, okay, all right. And this one, since we accept it because it's what positive. If it's positive, we just accept it. Okay, so that's what I Okay. So we accept it if it's what? Positive. Okay. So what is it? Okay, so we are moving forward. Now we have gone to the modern method. I think it will be better for me to, I don't know why my lecture note there's no to bring modern method up here so that anyone who pick the lecture notes will know that we have gone to modern method. Okay. All right. So the modern method, the most popular one in finance, everyone knows. Now, when they say NPV, every good finance student, what is NPV? NPV is the difference between what cash inflow and what cash outflow. Okay. Discounted cash inflow and what cash outflow, right? Okay. All right. So that is NPV for you. And NPV, we expect that the amount should be, whatever answer we get should be positive. Positive. Why not? Making a profit. So we go for it, that then you accept the profit. So in calculating this, when you start a project, you spend and you spend today, right? So it's the current value, present value, right? You spend today. It's the current value, it's the present value. Then the cash flow that will be coming is futuristic. Futuristic. So it will be coming. So we invest today, and cash flow that we know that this it will generate this money this year. The scale to generate this money, the tell you to generate the project, they are futuristic. So what we do is that in finance, we don't deceive ourselves and we don't put the amount as it is and add them and now subtract what we invested now. No, because a lot of factors. We are looking at inflation. We are dealing with time value of money, so that a money today is not what it's more what valuable than what a city today is more worthy or is more valuable or can do much than what a future amount. So we will discount the cash flow, the future cash flows that we are expecting to come to its current form. Then we subtract our cash what outflow from it. Then that is what we get the NPV. And if it's positive, we mean that if you don't discount it, a normal person who is not a finance student will not discount it and subtract and think he has made profit, but he has not taken time value, the time value of money into what consideration. So as good finance, we take that into consideration. To do that, so that is what we're going to do for MPV. Okay, so this is a question. The management of fine electronic company is considered an equipment to be attached with the main manufacturing machine. The equipment will cost 6,000 and make it Ghana City. We are in Ghana. We deal with Ghana City. You know, sometimes I have dollars in my letter note. Okay. So Ghana City, this one to us to be Ghana City. Okay, so that is so now we change to let's continue. They said that what the government is considering to purchase equipment attached to a manufacturing machine. So it's a long-term asset. The equipment will cost 6,000 and will increase annual cash flow by what? 2,200. The useful life of the equipment is 6 years. After 6 years, it will have no salvage value. Meaning that when the project or the equipment will get to a point when you cannot sell for any value. And then management wants a return of 20% on all investment. Okay. Yeah. So this one they've given us equal amount. Sometimes they give, but they give the cash flows will change. So that is it. So we discounted. Let me bring my pen. So we discounting. So meaning that we have to go for discounting factor. Okay. So first you have to get the years. Let me make this I'd like to increase this. Okay. Right. Let's go to 16. I think 16. Everything is here, right? Oh, no. Let's go to 14. Oh, so. Okay, then let's go to 16. I think for a better. All right, so that's it. So there's it. First of all, we said what? 6 years. The useful is 6 years. So we open our table. The parent on the vertical line is the year, and we recorded the year. And from the question, the cash flow is 2,200. It's going to be equal cash flow 200. Okay, so that is it. Now, after you've written the cash flow, in some questions it will not be equal, so take note of it. Then we have to now multiply by the discounted factor. I told you have to bring all this amount is the this will come a year after the inflation. This is futuristic amount which needs to be discounted to its present form so that we can subtract our current or present amount our present money we are spending from it. Okay, and we know the profit now. That's the net present value, right? So what will be our discounting factor? Let's see something. Oh, what is happening? Okay, so that's it. So discounting factor. We have 20% here. So that's how the formula will be. Like, so our discounting factor is going to be 1. This is our discounting factor over. It's 1 plus R. But we know the R to be 20%. So plus 0.20 raise the power n. We are putting n here because the number of years will be determined by the year that we are calculating. So meaning that in calculating this, we use this to calculate this. The first one would be 1 over 1.20, right? 1 plus 0.2 is 1.20. Raise the power 1, then we get this. Raise the power what? 1, we get this. Okay, so let me. So this one will be 1 over 1.20 all over what? All raised to the power 1. This one will be the same thing. This 0, please. This is 0. This one will be the same to raise to the power 2. Then we get this. Raise to the power 3, raise to the power 4, raise to the power 5, raise to the power. So you will see that as the years increase, the discounted value, the discounted value will be reduced. Okay. After you have gotten this discounting value, you multiply them by the cash flow of each. So if you multiply this by this, this is what we get. We bought 1,838 multiply 2,200 by this, get 1,587.68. Multiply 200 by this, and we get this. So we multiply this by this, we multiply and all this. After we add them, all of them, the present value of the cash inflows. Okay, so after we add all of them, this is what we got. We want to know the net present value. Okay, meaning we have to subtract our cash outflow, and in the present we spend what? 6,000. So we have to come and spend. That's the cash out. We have to come and subtract it from it. What is? Are we okay? So that is NPV. Now this NPV we got is positive, and therefore we are going to advise the firm to what? Make that what? Investment. Are we okay? To make that what? Investment. All right. So Let's go to the second one, internal rate of return. Internal rate of return. That's where internal rate of return. That's where we assume NPV should be what? There, right? Meaning that the present value of what? Cash inflow is equal to the present value of what? Cash outflow. Now, it's not as if they don't want to get any return on it. What they are trying to say is that now to make best decision for shareholders, because in running a business, our main objective is to maximize what shareholders worth, right? Yeah. So at the end of the day, we are doing everything to whatever happens, at least maintain their worth, don't decrease it. So NPV is want to is saying that at least we should what maintain shareholders what, and that will happen if NPV is equal to 0. Okay, so it shouldn't be there shouldn't be a case where the present value of our cash outflow is more than the inflow. Then we are then harming the worth of the firm. Okay, and shareholders' interest is being hurt. Okay, it's being ignored. Okay, right. So to accept internal rate of return, it should be more than the cost of capital. We all know cost of capital. It's the cost of using a capital. And we go there. That will be the next topic we will teach. Cost of capital. It's like, okay, let's take debt for instance. Debt, right? The coupon rate of return we earn on debt is the cost of, sorry, we pay on debt. The company is paying on debt. Is the cost of what? Capital. So cost of debt, right? So the cost of using that amount, the rate that is charged for using that amount, okay, is what is cost of capital. And we are saying that at least the internal rate of return should be more than cost of capital or cost of equity, right? Cost of equity, the cost you incur for using equity, the cost you incur for using preference shares. You should at least, so the cost of your capital structure, your capital, let me see, the cost of your capital, your return should be more than it. So let's say the project you are going to finance, right? The project you are going to finance it, right? And you are going to finance it with either debt, equity, or a combination of them. Now we are saying that the cost of capital, the cost of capital of this, the cost of that capital, should be less than the rate of internal rate of return, so that you get something on it. Okay, so if it's more than the internal rate of return, we say what? Accept it. Okay, so that is internal rate of return. Okay, so let's move on. That's an illustration. I don't know. Okay, so we can see that this is a question. It says calculate the internal rate of return. I don't know this. They say calculate the internal rate of return, right? Internal rate of return of an investment of 136,000, which yield the following cash flow. What is the initial expense we make? Get the project started, right? To generate some cash. The first year generated 30,000, the second year generated 40,000, the third year generated 60,000, the fourth year generated 10,000, the fifth year generated 60,000. So these are the cash flows. Okay, in its raw form. Okay, in its raw form. All right. Now, in solving internal rate of return, that's something we call trial and error. As we use get some rate and reduce it. Okay, and it's like solving NPV 2 times. Okay, so that's it. But our aim is to get one positive and one negative. Meaning that when you choose a rate and you get positive first, the next one you will solve, you should get negative. But we are going to use interpolate. We are going to interpolate, so we need both negative and positive value. Okay, so for my solution here, trying to increase the fund size. Okay, so for my solution here, okay, thank you. So for my solution here, you can see that is the fair calculation. The fair calculation. Okay. And this is the fair calculation. Okay. Now let's see. So let's say this part. Let me put some color there so that it'll be easy for you. This part is not part of the first part. Now, while solving and doing trial and error, I chose 10%. 10% rate of return, right? 10% of return. Okay. So that's what I chose when I was doing the trial. If I chose that, then it means my discounting factor is going to be. So let's not, we are just concentrating on this rate, right? For now, the one I like, we solve it okay later. So this is the cash flows. Please, you can either subtract this amount, and this one I want to have as near zero, the amount we spend on the year. Before the thing started to make it in the pressure, you check it, and the zero is your percent amount, so don't discount it. And it is bracket because we are what? Subtracting. Okay. We are what? Subtracting. If in accounting, when you will put it into bracket, means you are what? Subtracting. Okay. So let's go. So if we started this one, we started the year from year zero, and year zero, indeed, we spent what? There was a cash outflow of what? Of 136,000. Okay. So then year one, there was cash inflow of this money is coming, so it's not in bracket. 30,000, 40,000, 60,000. Okay. And it was 5 years based on the question. Okay. So now this, I told you, if it's 10%, then our discounting factor will be 1 plus R raised to power n, right? So we know 1 plus R, and R is what? 10%. 10% was 0.1. Okay, so instead of bringing 1 plus, I'll just bring 1, right? I hope you understand. So this is out of this formula, okay? Out of this formula, I've done it up there. Raise the power n, okay? This one I'm going to bring raise the power n because it depends on the, sorry, it's not supposed to be in this box. It's supposed to be just here, okay? It depends on the year and what's going to happen. Now, this year is 0, so when you raise this, raise the power is 1. 1 over 1 is 1. So at the end of the day, we multiply this here. Now, when we go to the first year, it will be 1 over 1 raise the power 1. We calculate it, get 0.90. Then second year, it will be 1 over 1 raise the power 2. Then we get 0.8, right? Then the third year, it will be 1 over 1 raise the power 3. We get 0.751. Are you okay? Then the fourth year to be raised the power 4, then fifth year to raise the power 5. Okay, so we get this thing. After, just like MPV, we multiply. So this one negative figure times 1, we are getting the same. Then 30,000 times this discounting value, we get 27,000. Get 40,000 times this, we get 30,000. After we add all, that is negative 1,300,000. Now this 2 is a positive figure. Okay. And I told you we need both negative and positive words. Interpolate. Okay. So what we do is, if it's positive and you want to get negative, increase the what? The rate you chose. Okay. So I got positive. So increase the rate what? Chose. Okay. Okay. So now 12%. Meaning this one is going to be 1 over the discounted factor here will be what? 1 over 1 point and 2%. The higher increase, the next rate of you not getting the negative rate. Okay. Okay, rate of power n. Okay. So that's what the same thing is here. 0, so rate 0, 0, rate 1. Okay. And when we rate 1, rate of power 1, because the 1 we get was 0.892. Rate of power 2, that was 0.797. Rate of power 3, that was 0.712. Raise the power 4, you get 0.636. Raise the power 5, you get 0.57. And add the figure. Now we multiply, please. This is the discounting factor for the second word. So we are using the same type of like 163, then you get how to work on this. Okay, so that would be that would be it. Okay. That would be it. Okay, so 1 times this one is for the first and when you get to one. The first one, so the second one. Okay, so it will be what this amount and this one, and this amount and this discounted factor is this time this discount factor is this time this discount factor is. So it's like the next step is to calculate. This is a formula for the calculation. Okay. So an internal rate of return, okay, we have what? M. It stands for the least rate of return use. NL is the least NPV reports. And NL, the same least for NPV report. NH is the highest NPV report. And H is the highest report minus what? L is the lowest rate of return. So we insert the values. 288. So the least rate report, the least rate of the NPV report for the least rate of return 2287. So insert it here. You insert it here. But the NPV report for the highest rate of return is what? 4192. But rate it times the highest rate of return you choose minus the least rate of return. So you multiply it with 10.70. Now I think we're not giving cost of capital to compare to both. And since it's positive, just use it, right? If we're giving cost of capital, then you could take a very informed what decision, okay? All right, so that's what I'm doing. Profitability index. Profitability index is a ratio, right? Now it is a ratio of the present value cash inflow and present value cash out. So look at the formula. Okay, so it's the ratio of present value cash inflow and present value cash outflow. Now if it's more than one, if it's more than one, okay. All right, so I don't think it says one NPV internal rate of return program, not one. Okay. We are going to discount them. Okay. So I think with the same question, this time we are asked to calculate what? Profitability index. And we said profitability index what? Okay. Point of capital to be okay, so that is it. So just like NPV, this one is it. This one we just discount their present value capital. So the present value of our cash outflow is set it now, so it's a time value. So it's back. The amount that the cash flow is getting in futuristic cash flow, you need to discount it to its present form and what? Okay, so that is so we just discount them and it's a different cost of capital of 10%. So going to be discounted factor is 1/1 plus 1. Now you know that has to be 10%. So the first year discounting value is 0.90. The second is 0.8. The third is 0.71. And the fourth is discount and get. After everything you multiply to get what the present value. 30,000 times this, 40,000 times this, 60,000 times 30,000 times this, 10,000 times this. So this is the present value. We add. This is not NPV. This is present value. Present value of the what? Cash outflow. Okay. Now, after you've gotten the present value of the cash outflow, the next thing is to pick our fund and insert it into them. Okay, so this is our formula. So our profitability then is going to present value of cash inflow, but cash was outflow. So we know the cash inflow when it is counted and cash outflow is 1/11. That is what was happening in the whole one, it was 1/1. And we said the project is affected because it's more than one. The project is affected. So this one was infected here, and our manager that we spent outflow person was infected here. That's 1.02. And so it is greater than and we are dividing it once. So that is it for capital, that is it for capital loss, targeting, and next time we are going to do cost of capital. So, and for today.